Welcome to today's Explainer, where we're going to definitively unpack literally the ultimate dinner party debate. You know the one, should you invest your hard-earned cash in real estate or should you just put it in the stock market? Today, we're totally bypassing the opinions and the hype. Instead, we're going to track two hypothetical investors over 2 decades to see who actually comes out on top when you won the real math.
Okay, so let's just dive right into this ultimate question. On one side, we have Jake. He buys a rental property. On the other side, we've got Marcus, who puts the exact same amount of money into index funds. Both of them walk away from their decision fully 100% convinced that they made the smarter choice. But the truth is, they might both be missing something massive. We're going to see what the math actually tells us when we strip away all the feelings, and more importantly, when we don't forget to count the hours or the zeros.
Section 1. The $50,000 question.
Let's set up a completely fair starting line for our two guys, Jake and Marcus. Now, both men earn $55,000 a year, they're the exact same age, live in the same city, and they both have exactly 50 grand saved up. The only difference is what they actually decide to do with it. Jake, well, he uses his $50K as a 20% down payment on a $250,000 rental property. Just a modest 3-bedroom house with a 30-year mortgage at 7% interest. Meanwhile, Marcus takes his 50 grand and drops it into a totally hands-off stock market index fund. No leverage, no tenants, no keys. He just sets up an automatic monthly contribution of $300 and pretty much completely forgets about it.
So let's look at Jake first. He scores a tenant willing to pay $1,800 a month in rent. Since his mortgage is about $1,330, on paper, that leaves him with what looks like a pure, crisp $470 in monthly profit before spending a single dime on maintenance. Jake looks at this napkin math, and honestly, it feels like an incredibly smart financial move.
On day one, the emotional contrast between these two is just staggering. I mean, Jake has this tangible asset. He can literally drive past his property and say, hey, I own that. His friends ask him about his new place at dinner parties, giving him this incredible social proof. Marcus is just sitting there with a really boring email confirmation from his brokerage. His coworkers ask him what he's investing in. He says index funds, and they just politely change the subject. But as we're going to see throughout this explainer, feelings and math are two very, very different things.
Section 2. The landlord reality check.
To really grasp this gap between perception and reality, we're going to map out their journey across 20 years. We'll be stopping at these critical milestones, years 1, 3, 5, 10, and finally 20, to track the difference between what these two investors expected to happen and what actually occurred in their bank accounts. Fast forward to year 3, and wow, Jake's gross cash flow looks absolutely incredible. If you just look at the rent checks coming in minus the mortgage payments going out, he's collected roughly $16,920 in gross cash flow. It sounds fantastic, right? It's the exact number everyone brags about at the neighborhood barbecue. But watch how ridiculously fast that 16 grand vanishes when we start meticulously subtracting the real-world costs. Over 3 years, property taxes drained $9,000. Insurance took another $4,500. He had to replace a water heater for $1,200, fix a roof leak for $2,800, and deal with a whole month of vacancy between tenants that cost him lost rent, plus cleaning fees. And you know, you've got to remember, these repair bills, they aren't just a string of really bad luck. This is what we in the biz call capital expenditures, or CapEx for short. These are guaranteed future replacement costs for major property items. Roofs only last 20 to 25 years. HVAC systems, maybe 15 to 20. These things will inevitably fail, and when they do, they require massive $5,000 to $15,000 chunks of cash. If a landlord isn't setting aside reserves every single month for CapEx, that early cash flow is really just a temporary illusion.
So after death by 1,000 cuts from all those little expenses, Jake's actual net cash flow over 3 whole years is shockingly low, sitting somewhere around just $2,000 to $4,000. And crucially, that doesn't even account for the totally uncompensated weekends he spent managing the property himself, taking 10 p.m. phone calls about broken toilets, and coordinating repairs on his lunch break.
Section 3. The quiet power of compounding.
Let's pivot and check in on Marcus. But hey, to remain perfectly fair to the real estate crowd here, we absolutely have to acknowledge that Jake has a massive weapon that stock investors just can't easily replicate, and that is leverage. Jake used his initial $50K to control a $250,000 appreciating property. So when that property goes up in value by just 3 or 4% a year, he is capturing growth on a $250,000 asset, not just his original $50K down payment. That is a massive, massive advantage.
Marcus, on the other hand, well, he's relying on a totally different weapon, compounding. Now, compounding feels incredibly slow and honestly pretty boring for the first 5 years. He logged in, saw his account go up a bit, down a bit, but eventually the gains on his gains begin to generate more new wealth than his original monthly contributions. That is when the math becomes absolutely astonishing and starts acting like a literal hockey stick on a graph.
By year 10, the math really starts to accelerate for both of our guys, and we see they are surprisingly close in wealth. Jake's property has appreciated and his mortgage has paid down quite a bit, bringing his equity to roughly $170,000 to $184,000. Marcus's stock portfolio, fueled by those steady $300 monthly contributions and market growth, is sitting right between $165,000 and $180,000. So the really crucial point here is this. They are neck and neck, but Jake had to take on hundreds of thousands of dollars in debt and concentrate all his risk in a single zip code to get there, while Marcus literally spent 0 weekends fixing plumbing.
But look, we've got to stay perfectly impartial here. Because Marcus's path, it wasn't perfectly smooth either. If we only look at the downsides of real estate, we're totally ignoring the gritty realities of the stock market. Stock investors face brutal volatility. In 2008, the market dropped 37%. In March 2020, it dropped 34% in a single month. Watching your net worth plummet by tens of thousands of dollars in weeks is completely gut-wrenching, and it leads so many people to panic sell. Furthermore, Marcus receives virtually zero usable monthly cash flow to live on. Sure, index fund dividends might pay him a couple $100 a month, but that's definitely not replacing his salary anytime soon.
Section 4, the 20-year finish line.
Okay, drumroll please. At 20 years, their total net worth lands in exactly the same ballpark. Jake's property is nearly paid off and has appreciated nicely, leaving his equity roughly between $400,000 and $500,000. Marcus's original $50K, combined with his steady monthly contributions and that sweet compounding market return, has grown to between $420,000 and $460,000. After 2 decades of entirely different strategies, they end up at the exact same financial destination. Marcus's final portfolio breakdown is genuinely fascinating. You've got his initial $50K, plus his $72,000 in total monthly contributions over the 20 years. And then you have that massive third component. Over $300,000 of his final wealth was just pure compounding growth. That's hundreds of thousands of dollars generated that required absolutely zero phone calls, zero tenant screenings, and zero emergency roof repairs. So, while the final numbers look, well, practically identical, how they actually got there is fundamentally different. Jake traded stress, constant attention, and his precious free time for his wealth. He dealt with illiquidity and massive concentration risk. Marcus, on the other hand, traded his peace of mind during those terrifying market crashes, but in exchange, he gained ultimate liquidity and complete freedom with his time. Basically, Jake worked for his wealth, Marcus waited for his.
Now, before we wrap this up, it is absolutely vital to note that real estate completely crushes stocks in certain very specific situations. If you're in a market with strong rent-to-price ratios where the cash flow actually works perfectly from day one, or if you utilize strategies like house hacking, living in one unit and renting out the others to bring your own living costs down to zero, real estate is a total powerhouse. Plus, treating it like a real business allows you to utilize incredible legal tax shelters like depreciation or 1031 exchanges to roll your profits into new properties completely tax-free. Stocks simply cannot replicate these specific tax magic tricks.
Ultimately, the real trap isn't picking real estate, and it's not picking stocks either. The trap is picking either one based on a flashy headline or a casual barbecue conversation without running the full math for your own life. So before you make your next major investment, leave yourself with this one profound question to ensure you truly understand what you're signing up for. Did you include everything? Because the answer that includes everything is the only answer that actually matters. Thanks for joining me on this explainer, and keep asking the right questions.